According to the ETFGI, an independent research consultancy based in London, the total assets invested worldwide in exchange-traded funds reached an all-time high at the end of August of $1.7 trillion. Now, despite a broad offering in South Africa, exchange-traded products still account for a relatively small amount of assets. Yet to make the case for ETFs is Len Jordaan from Stanley. Len, thanks for your time. The numbers we're just citing now do show and suggest that the take-up in the South African market has been extremely low. We're discussing before the show began that we're talking about an industry that's about 35 billion rand worth in a decade. Why has it been so slow?
It's probably the golden question, Godfrey.
Yeah.
We've analysed what's happened overseas, and we think that the growth in passive products overseas has grown together with high alpha products. And we're talking about hedge funds, we're talking about infrastructure products and the like. And the short answer is that pension funds and institutional investors in South Africa haven't been able to invest in the high alpha products, and because of that they've been reluctant to invest in passive products. Obviously everyone's looking to try and outperform the market rather than just to track the market.
Yeah.
So the core satellite argument hasn't really worked in South Africa because of the inability of pension funds and institutional investors to invest in high alpha products.
Yeah, I like to find people to blame. Is it the JSE? Is it the government? Is it regulation here that we're talking about? Is it perhaps ignorance on the part of investors themselves, both institutional, retail? Whose fault is it?
Well, I think it's a combination of factors. I don't think the JSE is to blame, funnily enough. But certainly regulation has played a big part. We are regulated as ETFs. We are regulated by the Collective Investment Schemes Control Act, and that does limit the assets that we can invest in. We're currently limited to investing in property, equities, bonds, and cash. And it's very difficult to come up with innovative products when you're only limited to those asset classes. And then I think that the regulation around investment by pension funds has recently changed. And it's probably the biggest change that we've seen in Regulation 28 for quite some time. And the industry will take a little while to adjust to those changes. We're certainly seeing the consultants, the asset consultants that work for the pension funds are asking the right questions about ETFs now. So we're very encouraged about the signs in the market at the moment.
Len, just to get back to the basics around the ETFs and where they fit into an investor's portfolio, we often have speak to people like yourselves, and you make the case as a passive investment provider that there's room in a portfolio for active and passively managed funds, the one to generate alpha and the other one to generate the beta. What's your sort of take when you talk about ETFs in terms of where they should fit in the investor's portfolio in a South African context?
I think it depends very much on which investor you're speaking of. So, with the proliferation of ETFs in South Africa, we have 35 ETFs are listed. The decision on which ETF to invest in has become an active decision. So we can't say as ETF investors that we believed entirely in passive investing, because you need to make active decisions when putting your portfolio together. When it comes to your institutional investors, we tend to find that investors use them for cost reduction. Obviously, passive investments typically are very cheap, and then also they are very liquid. So they do reduce the risk, the liquidity risk that pension funds might find in other investment vehicles.
We're getting into a bit of jargon because I wanted to understand alpha, beta. Explain it for our viewers, because if you're saying they're choosing one over the other or whatever the case is, what exactly are you saying in terms of why there's been a slow take-up?
What I'm saying is that passive investment just relies on mathematical models that tell you which shares to invest in.
Right.
Active management relies on fundamental analysis of the shares and other economic variables, those kind of things, where people try to outperform the market. What passive management does is it gives you the performance of the market at a very low cost. Obviously, there isn't a lot of intellectual capability used in supplying these kind of products, other than the index calculation. But certainly from a product provider perspective, it's very cheap to roll these products out and to scale them up. We don't need to employ additional people to manage additional assets, which usually an active manager would be obliged to do.
Yeah. Then comes in the age-old question about whether you need an active fund manager to do it, and then do they also manage to outperform the index? So do the costs justify the means? But perhaps that's an argument for another day. Let's talk about where you're using these in the South African environment. Where do you use your ETFs?
We would typically see them being used in balanced funds. So we believe very strongly in active management. Obviously, a lot of the value of active management is in the asset allocation decision. Depending on what research you read, in excess of 90% of your fund's return is actually based on asset allocation. So because these are very liquid and very low cost, they are a fantastic vehicle to get very quick access to asset classes. And they're all listed on the JSE, so you can trade through one stockbroker, but you can get access to gold or equities or bonds or mid caps or large caps or whatever your preference is.
So I think the argument for using obviously ETFs is that you get the market performance from ETFs. In your experience and from your knowledge, what's the because the argument is framed, make sure that you've got at least the market performance, and that's whether it be the all share index, the SWIX index, or the top 40 index, which the ETFs cater for. Then on the other hand, you've got the active fund managers that make the case for, hey, we guarantee we attempt to try and beat the market index. What are the sort of stats that you talk about when you sit down with investors in terms of what is the average equity fund's chance of beating a passive fund like the Standard 40?
We don't typically try and sell ETFs based on performance, and that's typically because we're not performing. Our benchmark is the index, and we try to give you what the index achieves. So if we track the index, that's really what our mandate is. It isn't a performance-based argument. When you're talking about our performance relative to active managers, it's very important to look at which periods you're looking at, because active managers do outperform indices in certain market conditions, but indices outperform active management in other conditions. So it's a very difficult question to answer. I think looking at a ballpark figure, you're probably looking at about 25% of active managers can outperform the index. The problem is that every year it's a different set of active managers, so it becomes very difficult to pick which active manager to have over the long term.
Yeah. So Len, how do we grow this industry then? I mean, we have spoken about the fact that the take-up has been very slow. How do we get it going? Is it the job of the government? I mean, there's been talk a lot within the industry about the change in Regulation 28. And then, of course, there's the other issue about the JSE and the role that they can play in all of this.
Look, the JSE has come to the party in terms of ETFs. We've had long discussions with them, and they are looking at the trading fees around ETFs, which is very encouraging. I don't think we can rely on the government to stimulate the market. They have been quite vocal on the fact that they believe that indexation and passive management is where retirement savings should be going, just given the fact that it doesn't dilute your yield as much as potentially the fees on active funds. I think it's up to the industry really to be more aggressive in selling packaged solutions, and we are able to do that now with private equity and hedge funds and infrastructure funds coming more to the fore and being more prominent in pension funds' minds when it comes to investment. So we've got to start chatting to the guys more actively, and instead of selling it on a passive versus active basis, which is what we've been doing for the first 5 years of ETF's existence, we've got to show the market how to use them more as trading tools within an active portfolio.
Just talking about those incentives, Len, you mentioned the incentives for the institutions to use ETFs, and that it's a very cost-effective way of getting exposure to the market. One of the things we've been fairly critical of, and when I say we, I talk about the financial journalists, has been the incentives that have been linked to the independent financial advisors. There is indications that that's changing. What's your experience been when you've looked at markets overseas where there's a different incentive for IFAs to manage funds as opposed to a commission-based incentive? And what has been the take-up with ETFs there?
It certainly has stimulated the ETF market offshore. London implemented this about 18 months ago, I think, where IFAs are paid a fee for managing a fund rather than earning commissions, and it certainly has incentivized IFAs to punt ETFs a lot harder than they would traditionally have, just simply because they aren't encouraged to support products based on the commission structures related to it. So we think that will happen in South Africa. There's quite a lot of talk about the remuneration of IFAs in South Africa and how that's going to change over the next couple of years. So we think that there is some potential for increased flows from the retail market.
These are the independent financial advisors.
Correct.
I think that's a very important stepping stone, and I think National Treasury want to go some way in addressing that in the future. Just coming back to the products that you currently offer, some people, once they've got the idea of an exchange traded fund and using it in their portfolio, will then have to look at the range of ETFs that are available. Can you just make the distinction for us between something like the Satrix, the Standard 40 and the Standard Swix ETF?
Yeah, so we've got two funds. The Swix index is basically a derivative of the top 40 index. And it's one that was developed because fund managers weren't able to buy, or they didn't have access to the full market cap of the companies listed on the JSE. So some of the market cap is listed in countries like London or New York, and managers here would actually have to use their foreign assets to buy those shares. So what they said is that isn't a fair reflection of the universe of the stocks that they have access to. So what the JSE has done together with FTSE is they've down-weighted those companies by the market cap that isn't reflected on the JSE.
Okay.
So the Swix index is basically a reflection of the top 40 companies on the JSE that are owned by South Africans, and the top 40 is the full market cap of those companies that's worldwide. So the Swix index tends to downweight the resource companies a bit, and the Swix index has got therefore a higher weighting in things like financial stocks and retailers.